All right, everyone, welcome. Thank you for joining us here for our Real Talk office hours with experts in turnaround and crisis management. We have our guest, George Katsanos, joining us. First, a little bit about Startup Grind. We are the world's largest startup community. We have 600 chapters in over 125 countries. And our mission is to educate, inspire, and connect. We have three values by which we operate. Make friends, not contacts, help others before you help yourself, and give before you take. And in that light, it was how I met George. George and then followed and came to me and asked if I thought it'd be valuable and be interested in hosting an update on global markets and have an expert roundtable where entrepreneurs and leaders could come and ask for actionable advice. The fact is, the majority of the entrepreneurs today didn't have to lead through the Great Recession. They weren't CEOs during the dot-com bubble. They've never seen anything or had to react to anything like this ever before. And how are they expected to do anything but follow their guts or reactionary examples of their peers? In the world of alternative facts and fake news, we should be informed, rational, analytical, and rigorous in our thinking. The pandemic has been and will continue to be the great leveler. And it's important that we develop this conversation into a global one. We'll try to have guests in the future to speak on different topics and markets over the next few weeks and months. And just a little bit of housekeeping before I pass this on to George is that the comments made and views expressed by all participants in this podcast are not intended to incite or invite individuals, entrepreneurs, or investors to buy or sell financial assets, real assets, commodities, futures, and or options. The purpose of this podcast is to educate and to inform, not to trade or invest. If you feel compelled to trade or invest, please call your broker. Now, with that, George, thank you again for putting this together today, and I will hand this over to you. Feel free to go ahead and share your screen and get going.
Thank you, Corey. Entrepreneurs, risk takers, welcome to our podcast. Let me start by this wonderful caption in The Economist a couple of weeks ago. The economy, as much as we would like it to run, is not going to move very fast, unlike people's expectations. Today is Federal Reserve Day. At 2 o'clock Eastern Standard Time, the Federal Reserve Federal Open Market Committee will express its views about interest rates against a background in which almost all central banks have either started or are beginning to start to monetize the economies. As we saw in Market Watch on Monday morning, the Bank of Japan kicked off a week for central bank action by lifting the cap on Japanese government bond purchases and boosting its purposes of commercial paper and bank loans. The Federal Reserve followed, and we expect that in tomorrow's meeting of the European Central Bank, similar actions and measures will be taken. Let me take you quickly today through the financial markets, and I would like to start with commodities. You may have heard that we have had a lot of volatility in energy pricing. Yesterday, West Texas Intermediate, if you look under energy on this side here, and under WTI, you will see that today oil is trading at $16 and change per barrel. It is almost 31% up against yesterday's closing price of $13. Yesterday during the day, we saw oil trading at $10 a barrel. As you have seen from probably from news in the press, this is a technical type of trading and is because of the excess supply of petroleum. We are running out of storage space for petroleum, and you should expect more volatility. On the other hand, the Brent oil, the North Sea oil, has been relatively stable between $20 and $22, $23. Let me move over to equities. Today is one of these beautiful, beautiful days where very rare indeed, but beautiful, where almost all equity markets around the globe, starting from Asia to Europe and in the Americas, have been in positive territory. What do I mean by that? The Nikkei is closed because of the national holiday in Japan, but the Hang Seng index in Hong Kong is up almost 5% this month. The Shenzhen Stock Exchange is up almost 4.2% this month. Australia is up 11% this month. And generally, the index for the Asia Pacific prepared by Morgan Stanley is up 5% so far this month. This is an important change. As we will see, it is being replicated and reflected throughout Europe. If you take Europe as a whole and you use the Eurostoxx 50 index as a indicator, you see that we're almost 10% up month on month. The FTSE 100 in the UK is up also 11%. The German DAX is 15% up from the lows a month ago. The French index is up 7%, and Spain is up 4%. Dow Jones, month on month, 14% up. S&P 500, 15.5%. NASDAQ, 18.5%. And essentially, when you look at the composite indices, they're also between 14 and 19% up. When you are gauging these significant improvements in equity prices, you have to look at the other side of the coin called bonds. The two most significant asset classes in which traditional investors have been investing are equities and bonds. And we as entrepreneurs should be following both of these, not only one, because they have signals about what other more intelligent investors and decision makers are expecting. If we go into Asia Pacific, which for the most part consists of emerging markets, we see that the 10-year bond yields, in other words, bonds issued by governments with maturity of 10 years, are ranging between a negative 0.06% for Japan and a positive 6.12% for India. These significant differences reflect not only different risk profiles, but also opportunities. And as you will see here, for the last month, the changes in these bond yields have been minimal. In other words, investors are still concerned. Look at Europe, Middle East, and Africa as a whole, starting with Germany and Switzerland, where we have record negative interest rates of minus 0.5 and minus 0.52% in both cases, Germany and Switzerland respectively, all the way down to Spain at 0.8%, Italy at 1.75%, and Greece at 2.13%. These ranges reflect, of course, budget deficits, government performance in raising taxes, and more important than that, European Central Bank intervention. If we come to the Americas, we have a fairly low interest rate environment in the United States and Canada at roughly 0.5, 0.6%, where we have minimal changing over the last month, and Mexico, where interest rates on a 10-year bond are at about 6.7%. If you look at currencies, we have a fairly interesting day, not particularly much movement, because if you look at the dollar euro, we have been only 0.33% change compared to yesterday at 1.8%. The same thing with the yen, dollar sterling, and so on and so forth. The relative strengthening of some of these currencies against the dollar is a probable reaction to the rallies in the markets. But we should be very careful here. And the reason we should be very careful here is because we are in the middle of earnings seasons, both in the US, in Europe, and in the rest of the world. And I will come to this in a moment. As I mentioned at the beginning of our conversation, today we have a pivotal event at 2 p.m. The Federal Open Market Committee is meeting, and the chairman of the board of the Federal Reserve, Jay Powell, is going to talk about not only interest rates, but also the policy of the Federal Reserve going forward. This is an important time because we do need clarification about the stance that the Federal Reserve will take. And this will determine the tone over the next several months. For entrepreneurs, for venture capital investors, and for risk takers, this is an important time. And what the Federal Reserve says counts a lot. So I would strongly recommend that you tune in to your videos, your cameras, or your TVs, your laptops, and listen to the statements of Jerome Powell. Tomorrow morning at 8:30 a.m. Eastern Standard Time, the European Central Bank will hold its own meeting and conference. And we expect that the ECB will come out with a big statement about intervention in the markets. So far, the ECB has been less active than the Federal Reserve. I would expect that this will change tomorrow. And this will have repercussions for Europe and for growth. If the central bank intervenes and helps deficit spending nations and companies in need, as the Federal Reserve has done, then we will probably see some support to all these unemployed and structurally imperiled companies. To this point, Pfizer announced that it may have a candidate ready for emergency use in the US by late in the third quarter of this year. This is significant. We also know that Sanofi, Glaxo, and Johnson & Johnson are working on clinical data. The sooner we have a vaccine, the better prepared we will be for potentially second or third waves of attack by the COVID-19 virus. As I mentioned before, oil is trading at $16, very volatile trade, technical trade. Why is this important? For us consumers, anything we have on the shelves in supermarket has anything between 20 to 30% energy cost involved. In other words, we would expect slowly to see softer prices in most of consumer goods because of the reduction in oil price. Remember, we came into the crisis with with oil at about $60 a barrel. At a third of this price, we should expect that consumer goods will slowly start also reflecting this change. As I mentioned at the outset, we are in the middle of earnings announcements, and I want to focus for a moment on Europe, where Google yesterday after the market closed announced very strong revenues dominated by advertising. 84% of all of Google's revenue comes from advertising. That is online advertising. Airbus, on the other hand, is facing a hard future. As the CEO mentioned yesterday in a conference, this is the gravest crisis the aerospace industry has ever known. Revenue was down 15%, and the company burned $8 billion cash in the last quarter. Boeing is not in a better situation. They're talking about raising a $10 billion bond from the capital markets. They announced yesterday that they're laying off 10% of the workers. Revenue was down 26%, and they're burning almost $5 billion per quarter. Ford announced really negative results. The losses are increasing, And we know that about 10 days ago, the company issued $8 billion at interest rates raising between 8.5 to 9.25% in bonds of different maturities. Today, the big announcers are going to be Tesla, cars, Hasbro toys, Spotify, Boeing announced results, as I mentioned this morning. Northrop Grumman also announced results in aerospace. Deutsche Bank, MasterCard, a financial institution, the Chicago Mercantile Exchange will also announce results. Boston Scientific, Raymond James, and so on and so forth. Keep an eye on these earnings announcements. You will see some companies are careful and do not give forward guidance, but you will also see that unless you are involved in internet and or online business, various sectors of economic activity have suffered from this pandemic. Last but not least, the Bureau of Economic Analysis published the quarter-on-quarter change of GDP in the US. GDP this quarter, the first quarter of 2020, was down almost 5% against the previous quarter. This is a big number. And let's hope that we do not have more declines of this magnitude ahead of us, although Q2 will take a hit. Last point on news, the National Association of Realtors announced that US pending homes dropped 21% this quarter. This is a big number. Let me turn to the next point that I would like to raise, that we have a rally in front of us. We've seen that month on month, most equity indices are up between 10, 12, 15% around the globe. This is predicated on optimism based on reopenings and central bank interventions. This morning, I was listening to some analysts speaking and mentioning that the Standard & Poor's 500 is trading at an estimated 22 times earnings. There is no doubt that, at least historically speaking, the equity market is expensive. On the other hand, we know that investors are looking for yield, return on their investments, and they have few options when short-term interest rates are at 0% and the 10-year interest rates for the US is at 0.6%, as we said earlier. Experts expect that the end of social distancing is likely to lead to consolidation. They also suggest that it will take longer for things to return to some new normal. As we mentioned on Monday, only 1 in 5 companies still provide quarterly guidance. And this is very simple because every item on the income statement and the balance sheet of these publicly quoted companies going forward is questionable. Visibility is a big issue for CEOs and boards of publicly quoted companies, but also for everyone. We are suffering, and I want to mention this, when we look at the financial results around us, when we look at the world, remember that we're suffering from biases. We have status quo bias, hindsight bias, loss aversion bias, and a herd mentality. When we look at the world around us, we should actually be critical, very critical, about what we see and what we hear. COVID-19 represents a historic hit and an unprecedented challenge for policymakers and risk takers. The pandemic has caused profound structural damage to national and world economies and has resulted in large dislocations. As we highlighted on Monday, our view is that entrepreneurs should not be expecting a U type of recovery. It is difficult to restart a world economy that is not synchronized. Here in the US, we know that different states pursue different policies. That means it will also be difficult in the US to synchronize growth. We should be aware that we will not emerge in an old normal. it is highly likely that the new normal is not known to us yet. Balance sheets will be different. The supply side will be different. The demand side will be different for every company, including these companies where we're advisors, we sit on the board, or we are involved on a daily basis. And I highlighted last time we spoke, but I want to bring this point again, that we have a huge discrepancy between top-down institutional investors and analysts and bottom-up CEOs, managers, directors of companies. Top-down, people are having an optimistic outlook. They are always suggesting, look through the current earnings season, be positive, look at the future, look at a year from now. Whereas bottom-up managers and entrepreneurs have no visibility. They're looking at cash flow and they cannot give any guidance. So net, I would recommend that we're careful going forward. We are analytical and we are much more focused into changing the way we operate in a successful way, if we can do that. I would like to close this part of the presentation expecting the unexpected in a way. We will see the debate increasing in the next few weeks and months about bailouts. We know that bailouts may be good, may be bad, but the net effect is when government intervenes in a market, in any market, you have price dislocation, discrepancies. And if you start tampering with price, then you have an inefficient allocation of resources in an economy. And you also have zombie markets and zombie companies, companies that should not be financed. Our view is and remains that the US economy will remain relatively strong relative to the rest of the world. However, we're expecting sovereign and corporate defaults. It will not be immediate. Keep your eyes on August, September, October of this year. Global risk is not uniform in terms of risk and reward, as we have seen. From minus 0.5% 10 years borrowing in Germany and Switzerland to 6% in India. And we have not even gone down other emerging markets that have challenges. We expect that distressed assets will increase, both in real terms, but also in financial terms. We also expect social unrest and social dissatisfaction to be expressed much more than before. The last 2 points that I will highlight here is that we also expect that we will see increased terrorist activity and cyber attacks. This is the classic climate for opportunists to hit hard. To remain resilient and agile if you can. Thank you very much. Corey, to you.
Well, thank you, George. I appreciate that. Again, a lot of great insight. And I also, for those who care to, please head to the startupgrind.com/grand-rapids webpage, because there you will find the previous recording from Monday. And that's where we'll be hosting also the notes. So the notes that George presented today will be available for download. Now, George, a couple questions. Now that, so in related to what you spoke about, now that you know, the PPP and a lot of folks maybe who have taken the loans, and now they're kind of maybe right back where they were before they even cashed that check. The window covering, the very thin veil, has been pulled back to the vulnerability of their original business model. Now that they have more debt on the books, do you have recommendations on how someone might be able to look inward to their business, and give an honest assessment of whether they should move forward or not?
Corey, thank you. This is a question we're hearing from many of our companies and managers around the area here. Um, the first point to look at as an owner of any business, as a manager or CEO or CFO of any business, is your cash flow. Cash flow is the single most important tool that we have. You need to start with a simple 13-week, roughly a quarter's worth of analysis of your cash flow on a weekly basis. As an entrepreneur, you need to start writing down your daily and weekly expenses and your daily and weekly revenue. Once you're able to see how you're performing, then you have tools, not emotions, tools as to how you go forward. If you are losing money over the next 13 weeks, then you need to take a step back today and ask yourself, why am I in a business that is losing money? What can I do to fix it, if I can fix it? Once I fix it, what is the business going to look like? The second issue is flexibility. You need to rethink your model of producing and selling. You need to look at your processes, your people, and your products. Not holistically, one by one, in a great detail. You also need to consider your liabilities, your longer term liabilities. What is your debt on your books, or is your debt on your credit card? Is there a way you can refinance it? Do you have sources to capital, which is equally important? Not only the capital that your business is generating, but capital that you can borrow in order to reinvest in the business, assuming the business is worth reinvesting. If your cash flow projections are negative, I strongly recommend you do not throw good money after bad, because it is likely that things are going to get worse before they get better. Unlike the public financial markets, the publicly quoted equities markets and so on and so forth, where there is a forward-looking perception of optimism, we as entrepreneurs should not be optimistic. We should not be using emotions. As I mentioned before, loss aversion is a bad guidance. We should be proactive in managing our cash flow. Thank you, Corey.
Yeah. Thank you, George. Now, we've spoken to the short-sightedness of a lot of entrepreneurs, especially small business people who have really maybe not a lot of time to look beyond what's in their cash drawer, right? And then the addictive nature of matching that short-sightedness with optimism. And then this culture of talking about like what success is and what that looks like. Maybe it would be interesting. I'm interested to hear your opinion on like how can we think of the word success in managing through crisis that might mean making the best decision for our families and winding down our business. Does that make sense?
I think you will need to rephrase what you're trying to say.
I'm interested in helping entrepreneurs reframe their thinking of what success is in the face of having to maybe wind down their business for the benefit of their family. Like, for example, maybe the story is, I successfully managed through this crisis by winding down my business. and this is why, or these are the decisions I had to make, rather than view not being able to make it through the crisis with a going concern as a failure. Maybe I'm just talking aloud here.
No, I think you gave the answer yourself to some extent. When we're defining success, we have to look into the origins of why we built a business. Why did we create a restaurant? Why did we create an online boutique? Why do we have a hairdressing salon, and so on and so forth? The reasons most entrepreneurs start a business is because they want to be independent. And they also want to manage their own risk. Also, quite often people start their own business because they have no other alternatives. They don't want to work for a large corporate, or they cannot work for a large corporate, or they came back from the army and they're starting a life afresh, and so on and so forth. To me, success is first and foremost using this crisis to learn. You have to look at your objectives as a human being, as an individual, and define what is success to you. To what extent success is something that your wife shares, your children share, is also important, because they're suffering with you. Success does not necessarily mean in monetary terms, oh, I bought 15 companies that were distressed, or I got intellectual property for nothing, and here we are now 3 years later doing very well, thank you. Success is about the social environment in which companies operate. Remember, increasingly over the last few years, we've seen this tendency towards social investing, and how companies that are aware of the social surroundings and they try to contribute to their environment are positively rewarded longer term by their investors. I think even privately owned companies should be looking at that. The idea of contributing to your employees, working with your employees, is also a form of success. Collaborating with your insurers to get better insurance coverage at this time of crisis, or with your bankers, provided they're willing to participate in your efforts to support the business and so on, is also a form of success. So when you're looking at the various stakeholders in a company, success means, in my mind at least, to find ways that these stakeholders will continue to grow with you. Yes, we will have ups and downs. Yes, we will have less pecuniary rewards, but you need to be building a team. Have I answered your question?
Yeah, that's real thoughtful. I appreciate that. I think it's it's an interesting discussion, and it's something that's on a lot of folks' minds as they lay awake at night, right? I'm interested because we do have Anne and Alex here with us. Not to put you on the spot, but if you have any comments on the discussion today or any questions, I'd be curious to hear.
Yeah, I guess. Well, my question would be, to what extent George thinks that the Fed will continue some sort of a policy driven by politics that is allowing zombie corporations to build up on debt rather than going bankrupt and laying off people. So what's your view on that? Because we have seen for the last month or two, this sort of approach by the Fed, which is sort of unheard. And to what extent, going further, we may even see something similar to the Bank of Japan, that is buying equities. by the Fed?
Alex, this is a wonderful question, and it is one of the key issues of what we call socializing the cost of the crisis. If you look into my notes, you will see that when we talk about bailouts, we have a moral hazard. And we know that bailouts that worked before, like the bailout of General Motors, may not work around this time. I think the starting point is that most companies, at least here in the US, are in better shape than they were in 2008. The financial sector is in a relatively stronger position, better capitalized, and with not as many toxic debts on their books. We have also seen that other investors, including hedge funds, private equity funds, VCs, and so on and so forth, have been far more careful in their investments. As you have probably seen from the demise of unicorns over the recent past, the very recent past, many of the startups or the early stage companies will disappear in this crisis or will be transformed. Your question about Fed policy action is a challenging one, and this is why I'm thinking that today's press conference at 2 p.m. is going to be important, because the Federal Reserve is aware of the political dangers. And as you're very well aware, the European perspective has been to be very slow in bailing companies out. In other words, the ECB has been fairly cautious in buying up corporate debt. Now, having said all this, we have two broad questions as societies. Do we go for 25 to 30% unemployment and social unrest, or do we try to use the financial resources that we have at our disposal in a consistent and prudent manner? The key question is to what extent the Federal Reserve will determine in advance the exit strategy. In other words, I hope that the Federal Reserve differentiates as to who is bailed out, why they're bailed out, on what terms these companies are bailed out, and what is the exit strategy. Your question has also become very clear, especially last week, when we were looking at municipal borrowing here in the US. There are members of Congress who think that badly run states should not be bailed out. In other words, the Federal Reserve should not be buying municipal debt or state debt from these states that have been badly managed. These are issues that I hope the Federal Reserve responds to publicly over the next few weeks and months. But this is really the essence of where we are at the moment. You're 100% correct. Thank you.
All right. Yeah. Thank you, Anne. Thanks, Alex. George, definitely thank you so much for the time that you're putting into this program as we move forward. We'll be doing this again on Friday at 12 p.m. Eastern. And then, as I mentioned, the recording will be available on the website, startupgrind.com/grand-rapids, along with the notes from today's podcast. So, George, thank you very much. Appreciate everything.
Thank you, everyone. Have a very good afternoon or evening.